Down payment. This is the third and final section of our pre-qualification puzzle. In order to determine what kind of down payment options are available, we really need to look at what kind of loan programs are available. The first two pieces of the puzzle, credit and debt to income, really give us insight and open the door to show what would maybe be financially beneficial for you. I want to take a broader look and step back and see what programs are available in general so that we can understand down payment options. Again, there's books and books of rules and regulations for each loan program, so this isn't intended to be all-encompassing, but more of a general outlook on what's available. We're going to break it down into three categories: Category A, Category B, and Category C. Let's start with Category A. We're going to call this conventional lending. This is where you find the standard FHA, VA, Fannie Mae, Freddie Mac, USDA loans. Most residential loans in America are going to fall under this category. This is where you find 30-year fixed mortgages with no prepayment penalty. This is where you're also going to find the lowest fees, the lowest rates, and the lowest down payment options. However, in this category, sometimes the underwriting guidelines can be a little bit more strict and have less flexibility, so it may not fit everybody's circumstance or scenario. In certain cases, it makes sense to look at Category B. Category B is what we call portfolio lending or bank lending. This is where a financial institution, such as a bank, gets to lend their own funds. In lending their own funds, they also get to determine their own underwriting guidelines. What's in, what's out. They determine their own risk. This is a positive because oftentimes they can make certain exceptions that Category A is not able to make. However, in this category, it could be higher fees, rates, or different terms on the mortgage. So this category can be good and bad. The flexibility in underwriting can allow for approvals that doesn't fit Category A. But in exchange for that approval, the fees or the rates or the terms of the loan can actually be higher. And this category generally requires a larger down payment. Be sure to check out our video about types of lenders that are out there, because not all lending is equal. Some lenders can't even offer Category B, let alone Category C, which is our next category. We're going to call this unconventional lending or private equity lending. This is when a private equity group pools money together to lend to higher risk clients that do not fit Category A or B. In order to make their risk worth it, they're going to lend at a higher rate and higher fees. Examples or scenarios that may fit this category would be bankruptcies, foreclosures, low credit scores, no credit scores, bank statement loans, fix and flip loans, etc. This category is definitely not for everybody, but I wanted to give you a high-level view of what's actually out there. It's important for us to understand the types of lending available, but for the purpose of this video, we're going to jump back to Category A. This is where a majority of the home buyers are going to fit. And remember, we're going to do a 100,000-foot view. There's thousands of guidelines for each individual loan program. And for the purpose of our video today, we're going to be assuming that it's a primary residence. Second homes and investment properties have different nuances that we're not going to get into. One thing I want to mention as we continue to talk about the lender's perspective, they're always looking at risk. Specifically when we're talking about down payment or minimal down payment, the lender is concerned about their risk. For example, if they let a buyer buy a house for minimal down and the market changes or the values of the home drop, and the lender finds themselves with a buyer who owes more on the house than the house is worth, that is a bad spot for a lender. The lender is going to hedge their risk through what we call mortgage insurance, or sometimes it's called a funding fee. Let's put it this way. Let's say 1,000 people get a loan from a lender and one person ends up defaulting. 1,000 people put into that pot to hedge the risk of that lender for the one person who defaulted. Certain loan programs allow you to put as little as $0 down, such as the VA loan or USDA loans. Let's start with the VA loan. This loan is specifically from the government for our active duty military and our veterans. Thank you so much for your service. Depending on your length of service or the branch that you served in can determine your eligibility. To find out if you're eligible, you can go to the VA website or click the link below or talk to your seasoned mortgage banker. Once you determine your eligibility, you may have options to put as little as $0 down. As we discussed before, how the VA protects the risk of the lender is through what we call the funding fee. The funding fee may change depending on your specific scenario, and in certain circumstances, it may be waived altogether. This is an incredible loan to help our active duty service members and our veterans become homeowners. One other loan that I want to mention is the USDA loan. This is another loan product that allows you to put as little as $0 down. It's specifically designed for rural properties, so the property itself has to be on the designated list. This is also a loan that uses the funding fee to hedge the risk of a lender, and those funding fees can vary. Next, we're going to look at an FHA loan. An FHA loan is another government loan that allows buyers to get in for minimal down. The minimum down payment on an FHA loan is 3.5% down. As we discussed on the VA loan or USDA loans, the funding fee is what hedges the risk of the lender. In this case, it's mortgage insurance. FHA requires an upfront mortgage insurance premium that gets charged on top of your loan. It also requires a monthly mortgage insurance. Both of these are to hedge the lender's risk to allow 3.5% down for their buyers. Finally, we're going to talk about conventional lending. Conventional lending is a broad term for lots of different kinds of loans, but most often it refers to loans that are backed by Freddie Mac and Fannie Mae. Conventional lending allows you to put as little as 3% down. But a word of caution, sometimes the 3% down loans do have income limit restrictions. So make sure you're talking to your lender and asking those questions. If the 3% down options aren't available, don't worry. They still allow you to put as little as 5% down in most circumstances. One thing I want to make note of is the first-time homebuyer down payment assistance programs. These can be an incredible opportunity to help get you into a home. Most of these programs are going to be state, city, or county specific. All of these programs are going to be built off of the FHA or conventional loans that we just discussed. So make sure you're talking to your loan professional about some of the details and options that are available for you. Now that we've briefly looked at some of the loan options or down payment options available, we need to consider your all-in costs. This is going to be the second most important number of the entire pre-qualification process, only to your gold number. We're going to call this your silver number. Look at your budget. Look at your bank accounts. What do you feel comfortable with as your maximum out-of-pocket expenses for getting into a home? Everybody's different, so make sure that you're communicating this number to your lender. In order to get to your silver number, we not only have to consider down payment, we also have to consider all the other fees that are associated with a real estate transaction. We call these closing costs. Closing costs are going to be things like title fees, flood certs, appraisal fees, lender fees. Make sure you're checking into this because each state or individual property may vary on what the closing costs will be, so you know exactly what you're bringing to closing. Not only do you have closing costs, but you also have prepaid items. Prepaid items are going to be expenses that you're prepaying at closing. A few examples of this would be your daily interest charge, depending on what day of the month you're closing, or your homeowner's insurance, or taxes, or potentially HOA fees. So to calculate your final cash to close or your silver number, you need to make sure that you're including your down payment, your closing costs, and your prepaid items. So right now, I know that many of you might be feeling overwhelmed. It might feel impossible to ever get into a house or save enough money for a house. Don't be discouraged. Sometimes setting real expectations and looking at real numbers helps to set a goal. But I also want to mention a few ideas that oftentimes get overlooked to help you get to your down payment. Stocks, mutual funds, potentially retirement accounts, or selling assets such as automobiles, RVs, gold or silver, and even gift funds from a family member. Each one comes with its own guidelines, so make sure you're talking to your loan professional. But I want you to start thinking outside the box. As we've seen through the entire pre-qualification process, there are so many nuances and specific circumstances and situations. But now that we've explored down payment, you're able to get to your silver number. As you begin to explore what you're comfortable with, not only on your silver number, but also your golden number, we're able to come up with a realistic plan that's affordable for you to get you into a home.